Say that one more time, Jewel. You broke up a little.
Also, who wrote the book of what
It's
we're
by
talking about?
Garrett Gunderson.
Garrett Thunderson,
It's by
THU.
Garrett Gunderson. Mhm.
Okay.
Yeah, Garrett
Okay.
Gunderson.
Okay, bet. Okay, thanks. All right. So which one are your faves?
Mhm.
IULs or whole life?
No problem. It really depends. It really depends on a lot of things, right? I would say ultimately what you want to get the plan for, right? If you, depending on if you're risk averse or not, whole life tends to grow safely and permanent in nature. All the universal plans tend to have a little bit more aggressive growth in them. So it really kind of depends on your appetite, and I would say what you want to leverage the policy for. If I'm looking to leverage the life insurance policy to where I want that equity to be steady in growth, I would probably and a little bit of death benefit focus, I would probably level whole life. If I wanted some the potential for return, I would leverage some of the universal life plans. It just kind of really depends on your appetite. I have both. I have a lot of different types because I have a lot of different goals that I want to leverage the plan for. So it really kind of depends on what you wanted to use it for.
Okay,
And
so
what I like
let's
about it is,
yeah. Go ahead.
no, I was going to say what I like about the equity inside of a life insurance policy is to your point earlier about using it for growth. It's really just math. Okay, so you have a life insurance policy and it may be growing at 5, 6, 7, 8, 9, 10%, depending on how you design it. But then you borrow your money from it. So you want to make sure, right, when you pull that money out, that you've done the math, you've done the research to where if I take out 40 grand and I put it into another project, that project is going to be giving you some return better than the rate at which you borrowed from, you know. And a lot of times when you do the math, most of the time, not all the time, um, there aren't other lending terms that can give you a better rate than if you were to borrow from a life insurance policy. So if you were to go to a bank nowadays, they may give you money at 6, 7%, right, depending on what the type of loan, right? But I would say 8 times out of 10, that rate is higher than the net rate of when you're pulling from your life insurance plan. So it's a lot of, I would say, just make sure it makes sense financially, mathematically, before you just, to your point, pull it out money, just kind of using it over here with no purpose or intention. You want to make sure you have a plan in place and that money is working for you to where when you get done with that project and you have some cash, you can put it back in your insurance plan and you're ready for the next one. You can be your own hard money lender, if you will.
Absolutely. So basically what you do is you'll look at a person's age, you'll look at their health, you'll look at the monthly fee that they're actually going to start to pay into the premium.